how can a money market fund business essentially be trading at this? And I'm like, I've seen this before, and I'm like, there's one of two answers. Either it's a massive bubbling circle and, every retail wants to buy it and everyone's got it wrong, or none of us understand, but this is a network stock. Because as we know, Metcalfe's law values things very differently. Most things are network stocks nowadays. And then we saw that announcement yesterday. They've got like a gazillion partners building on top of a network. I'm like, well, there you go. Because everybody tries to value this stuff via cash flows, and it's the wrong way of doing it.
Hey guys, welcome to Everyday Finance. Due to a global move into risk-off mode, cryptocurrency investors have experienced one of the most extreme swings of the whole cycle over the past week. As the overall market capitalization fell to about $2.73 trillion. It began with concerns that the AI bubble had overheated, driving tech lower and taking cryptocurrency with it. In a single day, almost $1 billion in leveraged positions were sold. And Bitcoin fell below $90,000, wiping out almost all of its annual gains. However, that was just the initial blow. The big blow came on Thursday when Bitcoin saw its worst liquidation event since 2022. It's plunging into the low $10,000 range. A single wallet dumped $1.3 billion in Bitcoin. Institutional flows turned sharply negative. And US spot Bitcoin ETFs saw roughly $1 billion in redemptions in a single session, all of which contributed to the panic and acute dread. Although Friday provided a moment of stability, the harm shattered structures, increased volatility, and shattered confidence remains. However, the fact that consumers seem to be filling in amid the disruption showed that demand is still alive. And today's discussion is precisely framed by that sliver of resiliency. According to seasoned macro investor Jordi Visser, this was a quick liquidation of an asset class that moves quickly by nature rather than a systemic breakdown. He points out that despite the turmoil, Bitcoin is only marginally down so far this year. If it rises to six figures by year's end, it would be up overall. The real question is not how far prices might drop, but rather why they plummeted so quickly given that Bitcoin is at 7-month lows and the entire cryptocurrency market is under strain. Visser identifies persistent long-term tailwinds, including AI adoption, asset tokenization, and regulatory clarity, and attributes them to leverage, emotion, and forced selling rather than underlying fractures. In order to illustrate what these strong washes usually portend for the months ahead, Raoul Pal delves into historical precedents of quick de-risking later in the video. Please remember to hit like, subscribe, and comment if you would. Want a more detailed roadmap for 2025 and 2026? The insights that follow may cause you to adjust your approach.
Yeah, and that starts to get into this point that I was making about, so if you get to abundance and the robots are making all the money, theoretically, so if they're making all the money, then that means the government's making the money because the government owns the robots and blah, blah, blah. And so the money gets equally distributed, the profits. So the country becomes profit sharing, meaning, okay, everyone has a share in the economy and you're all getting a certain amount. That's really what UBI is in abundance. But before we get to that point, the reality is Bernie Sanders has talked about taxing any companies that are using robots. So actually taxing the companies. Forget the belief in this. I think the first taxation will come from the electricity side, meaning you guys are going to have to pay for it.
It's much easier than saying to Amazon, that's a robot, that's not a robot. That's really hard to do.
Yeah. And it's cheap too. We haven't gone through, people don't realize the numbers, but when you go through the electricity spend in a year, I hate to tell everyone, I know it feels bad when you're spending it, but your electricity bill is not as much as your car insurance. It's not as much as your homeowner's insurance. Like it's
look
not
what it
a
does
huge
to your life.
Exactly. So to the hyperscalers, this is an odd lot for everything. I think Jeff Bezos could play for everyone's electricity bill for like the rest of time and no one would ever know.
I think that's a really good way. So as opposed to taxing further down the chain, you just tax at the beginning of the chain. So, well, you can't have compute without electricity, so we'll just charge you for that.
Your
we'll
cost
charge,
is X. Yeah.
Whatever it is per kilowatt, and that's your tax, and off you go, keep doing it.
Yeah, I heard someone, and I forget where this was on, but you can go look it up on your own. of the margin inside what they get. So like for the $20 they charge for using ChatGPT, the electricity cost is zero. It's literally nothing.
Here's an interesting one. So I was talking a lot about okay, it's commonly accepted that humans are the most efficient compute that exists. Right? We take in very little food, out of it comes whatever IQ, consciousness, and all of these things, right? Pretty amazing, plus all this biological stuff. So we're pretty amazing. And I mentioned it to Emad, and he's like, you don't get it. I'm like, why? I'm like, this is true. He's like, no. And it's dawned on me. These models, if you think of the share that my instance of ChatGPT uses in electricity, let's assume they break even from charging me for what services. And I pay $200 a month for the Pro. So for $2,000 a year of food, for the entire cost, I get 160 IQ in every subject known to humanity.
Exactly.
So these things are already more efficient than humans. And I don't think people are ready to understand this yet, which is why, to go back to your earlier conversation, well, every company is going to replace humans because they're so much more efficient. Not just in terms of employment costs, just the pure energy costs. They're now cheaper than us.
Yeah. And since you referenced him, Imad has spoken many, many times, and one of his best quotes is, when you're at work and if all of a sudden you have an AI person in a team, so let's assume it's one AI and 4 humans. Well, the smartest person is the AI and the other 4. I mean, that's all you need to think about. Like, that is the reality. And so the marginal cost of those employers, everything that goes associated with it. Like, someone had made the argument, well, these humanoids are going to be expensive. I'm like, you're not listening to Elon Musk and you're not thinking about it clearly. A human being that works at a company, at a Fortune 500 company, with healthcare, with everything, is very expensive compared to a humanoid. Is very few businesses, particularly on Wall Street. I mean, the lowest level person at one of the banks is making more than what a car costs. Well, a car is far more complex to make than a humanoid. It's bigger. Aside from them developing the hand and getting the pieces, once they do that, it's much easier to make those than it is a car. So it's just a very, very weird thing that people haven't put to context how much money you're saving by having them, including the fact they work 24 hours. You don't have, like, they don't complain.
I want to go back to, we talk about companies and how people don't understand something. Circle, right? So Circle IPO'd and it rockets up in value, and everyone's like, what the fuck? How can a money market fund business essentially be trading at this? And I'm like, I've seen this before, and I'm like, there's one of two answers. Either it's a massive bubble in Circle and every retail wants to buy it and everyone's got it wrong, or none of us understand, but this is a network stock. Because as we know, Metcalfe's law values things very differently. And most things are network stocks nowadays. And then we saw that announcement yesterday. They've got like a gazillion partners building on top of a network. I'm like, well, there you go. Because everybody tries to value this stuff via cash flows, and it's the wrong way of doing it.
Jordi makes one thing very clear. This decline is concentrated rather than systemic. The S&P 500 is still only a few % off all-time highs. Despite significant selling in cryptocurrency and speculative retail names, he can learn everything from that split. This is a fear-driven unwinding brought on by anxiety over how quickly the world is changing, not a fundamental breakdown. AI is shortening economic cycles, changing attitude every month, and negativity spreads more quickly than facts in a K-shaped economy where some people prosper while others struggle. Because of this, measures of fear and greed can reach extremes, even when global markets are still up double digits for the year. According to Jordi, people are trading narratives rather than fundamentals. As sentiment plummets, Nvidia keeps destroying earnings. Gemini recently unveiled its most robust model to date, and innovation keeps speeding up. In the past, that combination signifies the emergence of bottoms rather than tops. This leads him to his more profound realization: why this sell-off doesn't seem like the previous 80% cryptocurrency drawdowns, and what its structure reveals about Bitcoin's asset development.
I mean, you hit on the important thing, and one thing I said this year. So I did believe stablecoin would be the big thing this year. I'm very surprised Bitcoin's only up, whatever it is, 18% year to date, but stablecoins have been the reality check for everyone in understanding, and it was because of the network effects. You can actually grow, and the visual or the analogy I've tried to give to people is, let's assume there's two casinos right across the street from them. One of them is this old, like, rotted down one, but it's the one you go to all the time, and it's the one you're familiar with. You know everyone in the place. And you're a boomer going into that casino, and that casino has most of the money. And then across the street is this very shiny casino, brand new, you don't know anyone though. So it's scary. But once you go over one time and you play in that casino, you're never going back to the old one. And that's what the digital economy is, and that's what the network effects are. The network effects will allow wallets to be open easier. And once the wallet's open and your money's in there, I've asked people the same question. Hey, the money you've brought into crypto or the digital economy, have you ever brought it back? No. Nobody ever brings it back.
No.
And that's why I keep saying it's like, you can have two casinos, you can be gambling in both, but at some point when the other one's all old and rotted and it's just not fun, you just move over to the one that's young and shiny and everything's better. And maybe it takes everyone dying before the money moves over and you hand it to the kids and they're already over there, but it's happening. And I think what Circle and all of these things are is they're getting more financial volume going through this system. And once more money is in there, we're not going to get to talk about this way, but this is another macro thing we could have talked about, and I don't know what your view is on this. I was very interested to see what happened with Malay this weekend. And the reason was...
Yeah, how did you read that?
Well, the way I read it was this. It was a very interesting thing that the administration basically said, we'll give you $20 billion. They're trying to impact the election. They're trying to get the voters to go, that you have the U.S. help. Now, if it didn't work out, everyone who is a local is going to take their money and put it into dollar stable coins. So the money's coming back in the U.S. Either way, the U.S. wins in this. So by using the swap, and I believe 100% that this is the mindset now, it's one of the reasons why I think the big sellers in Bitcoin are absolutely out of China. I think it's Bitcoin miners. I think it's family offices that are in mining. I think it's people that have held a lot of this stuff because I think China's cracking down on this whole situation. It's been part of it. And even though the crackdown's been happening, I don't think enough people are realizing the flow dynamic that's going to happen with stablecoins. Stablecoins allow for what I didn't see when I lived in Brazil, which is there was a black market, but it was very difficult to get your money outside the country. With stablecoins, any individual that's worried about the depreciation of the peso can take it out in a second. So we learned that with Silicon Valley Bank. I don't know why people didn't think about what could happen in Argentina. Very similar to Silicon Valley Bank, because a bank in the U.S. which took in all of this money, it was all evaporated in a matter of 48 hours. And the reason was because of the version of stablecoins, meaning it was digital money that was able to be taken out very quickly. The same thing will happen at some point with an emerging market country where someone loses, and you're going to have a run on the country, and it's going to happen at some point. And you've seen the ECB and China both publicly talk about the fact that they're worried about the dollar stablecoin situation. They don't know how to handle it. China wants their own CBDC. They want their own digital yuan. But the problem is, I think for these countries, it's going to be an issue. So that's the reason why I think Argentina was an interesting test case. He won. It didn't go out. But you give money to get the votes, and if it doesn't happen, the money's going to come right back into America.
Yeah, and I think there's obviously a geopolitics game that finally is getting played in South America, which is like, we need all of this as part of our sphere of influence. The other thing that's interesting, because we were talking about Circle and its IPO and the network effects, stablecoins are now network effects on the US dollar. You've made it a digital network layer, which can be built on instantaneously at scale by anybody permissionlessly. Holy shit. People have no understanding what that means.
It's the financial guardrails they're going to change rapidly now. So it's a little surprising that the market cap hasn't grown faster, but I think some of that has to do with clarity not being done yet. I think clarity is a big event. When that occurs, and with the timing of everything that's gone on, you're already seeing all these, JP Morgan allows collateral, Citi, that everyone is kind of already starting to think about how the guardrails will be, and they have to compete. They have no choice. And today in the market, Fiserv was down huge. It was down 40%, this fintech company. And I immediately go into an LLM and go, what is their stablecoin plan? And it said in there, well, their stablecoin plan is as of June 23rd, 2025. I'm like, okay, did they have one before that? And they didn't. And so the reality is if you haven't had a stablecoin plan for the last at least few years, that's what made Stripe very important October of last year when they went out and bought Bridge. That was and
Visa had the plan,
exactly.
MasterCard, they're all there.
They're all there already. The banks are trying to catch up, but I think the financial guardrails are changing. Tokenization is really the most important part as the next step. And I don't think people have fully grasped the tokenization side, how important it is.
And also just what we're saying is that we're now allowing anybody in the world to build on US dollar rails at scale in any country for any person. I mean, what does that do to the US as a source of capital? I mean, it becomes the world's capital only. I mean, this is why China and Europe are terrified, because this is so powerful, because everybody uses it. It gives the US the largest weapon ever known, which is the currency. But you just think of what that does for crypto rails, the whole thing. It's like, it can't be overemphasized how big this is. And we barely started, as you said. Next year, it's going to be all about stablecoins.
The last macro layer is added by Raoul Pal, who observes that the current crypto meltdown, which is characterized by quick unwinds, worries about liquidity, and rumors of market makers blowing up, resembles the violent sell-off of 2021, when Bitcoin, Ethereum, and Solana fell more than 50% in a single month before rising to new highs. Although he finds this decline to be equally perplexing, he notes that the macro environment is still overwhelmingly positive, which means that once the forced selling stops, a strong comeback is not just feasible, but likely. Pal emphasizes that situations like this have happened numerous times previously, frequently reversing so quickly that the majority of investors fail to re-enter. Despite the fact that prices are incredibly oversold and the suffering is unrelenting, although he freely admits how severe the volatility is, he reminds us that nothing in the fundamentals points to structural failure. Liquidity is still growing. Innovation is picking up speed, and institutional participation hasn't decreased. He contends that rather than actual devastation, we are witnessing mechanical de-risking. Though typically these chaotic washouts conclude with explosive returns that leave sidelined investors behind, the missing element will become apparent in hindsight.